Is it really true that one of the easiest investment strategies to implement turns out to be one of the most profitable? Fortunately for all of us, this turns out to be true and has been so for many years. In 2024, passive investing has finally overtaken active management in the world's most important equity market, the United States. And this is no great surprise, given that only 1/3 of those trying to beat the market as their sole and dedicated purpose actually managed to do so. And you can benefit from this too. So today we're going to be covering all the basics of passive investing using indices, starting right at the beginning with what actually is an index. So an index is a collection of shares bundled together, and importantly, they are governed by a set of rules to determine which shares should go into the index and how many. As most of you will know, a share is a small piece of a company, and owning a share is a part ownership in the actual business. This allows you to vote on important matters for the company and also to receive some income in proportion to your share when the company declares and pays a dividend. An example of a simple index could be something as straightforward as Apple, Microsoft, and Amazon equally weighted between the three. And so what the index would do, it would have a number of shares equal to 1/3 of the value in each of those stocks. Now, obviously you wouldn't invest in an index like that in practice unless you had a very specific purpose. But this brings up a good question of why invest in indices in the first place? Well, one of the favorite things for retail investors to invest in is single stock equities. And that's because you can read into the story of a company, look through the fundamentals, and decide for yourself which companies you think are going to do well and going to do badly. The unfortunate thing is that this takes an incredibly long amount of time. And sometimes, even if you read through all the stuff and the experts get this wrong all the time as well, there's things that you just simply can't know as an end investor, which means that occasionally these single stocks blow up because of fraud, accountancy issues, all sorts of reasons that are out of your control. This makes investing in individual companies and just buying one company's shares quite risky, as well as taking a very long time to research, which most people don't have time for. This is then where indices come in, because what you can do is you can bundle together lots of different shares from lots of different companies all together in one big package to achieve diversification. This means that you are not on the hook and you're going to lose all of your investment if one company goes bust, for example. As you can imagine with this approach, you miss the very large returns that you can get from individual stocks that multiply up by 3 or 4 times, but you also miss those massive losses as well, which is why for the average investor, indices have proved extremely popular. Now, I mentioned before that indexes are rules-based, so each index will have its own rule set as to what it looks at based on the investment strategy that it's going for. And one of the most common rules within this subset is market cap weighted. And what this means is basically the amount of each company that goes into an index is proportional to the size of the company on the stock market. This is how an index that's very well known, like the S&P 500 works. The biggest companies make up the lion's share of the index, and smaller companies make up a smaller proportion. Most indices work like this, and you also usually have a regional filter to most indices as well. The S&P 500 being the 500 largest companies in the US by market cap. You have something like the FTSE 100, which is the UK's largest 100 companies. So there's usually a regional element to most of these indices. In addition to this, sometimes you can have sector as well, and technology is in particular quite popular in the United States, but you could also get healthcare, consumer staples, industrials, that kind of thing, although those ones tend to be not as popular as tech. Broadly, all of these different types of indices, and there are many more that I haven't mentioned, are typically referred to as passive investments, as opposed to the active management of a fund, which has a fund manager who goes and picks individual stocks or runs a particular strategy that is in some way discretionary and allows them to have a bit more flexibility about what they do. The interesting thing about passive strategies, though, as an end investor, you don't really have to do very much because the rules are governed by this rulebook. But you do have to remind yourself that these strategies are an investment choice. Nothing is truly passive because these indices rebalance on a regular basis. The S&P 500, for example, rebalances every quarter. So some stocks that got too small get kicked out of the bottom, and some stocks get added in as they rise up through the list and enter into the top 500. You also have new shares that turn up and are quite big on launch, so those get added in the next quarter, and other stocks which get delisted for other reasons, for things like lack of liquidity. Say you've got one really big insider holder, which means that there's actually not that much stock out there on the market. There are special rules in these rule books to stop thinly traded instruments from getting into the index, which makes it hard to replicate. So it is an investment strategy, it's just one that seems to work really well and is done on a systematic basis. This is probably the most surprising thing about the passive indices, is that they outperform the active managers most of the time, especially over long time horizons. The average return of the S&P 500 in the United States over the long term has been 7%, and that is after inflation. To put this into context, if you started with $10,000 invested in year one, this becomes $71,000 over 30 years because the 7% compounds on itself every single year. In the first year, you make $700, but in the second year, you're making 7% on $10,700 and so on and so forth. So the actual amount that you end up invested at the end snowballs up and up as time goes on. What is a more useful and realistic comparison is something where you're investing regularly, and this is how a lot of investors get started. Say you started with, just for example's sake, $10,000 in an individual year to begin with, like we did in our previous example, and you add $10,000 more every single year. Well, by the end of the 30-year period, you'll have $945,000, but you only invested 310,000. And this is just the power of putting money into the stock market. The index element is what allows you to have this diversification and not get too burnt in any individual down year, but allows you to perform consistently over the long term if you've got an investment horizon of 10 to 20 years, for example. So what's the catch? Is it really that easy? Well, first off, you do have to bear in mind that 7% is an average, and the stock market can be absolutely brutal at times, even if you're invested in indices. When you have a very big problem that occurs across most of the world and the entire economy goes down, well, obviously the entire index goes down as well because every individual stock usually goes down in tandem. In really bad years, you can even have big drawdowns down as much as 40%. So if you're starting to invest in these things, you have to make sure that you are investing for the long term. And again, this means that you won't need the money in the next 5 years because then that will allow you to ride the wave out. It's very, very difficult to attempt to time the market. Sometimes it's kind of obvious when to get in, but usually that's the point at which it feels like the entire world is falling apart. And who knows, maybe it'll go even further, which is the reason why lots of people do a little bit every month, for example, over many, many years, because it means that sometimes you're getting in when it's more expensive and sometimes you're getting in when it's a bit cheaper. The market recently has been reaching all-time highs consistently over many, many months, and lots of people are calling the market overvalued, but until there's a particular catalyst or a trigger, this can continue on for many years, and it's usually to your disadvantage to pull money out in anticipation of a fall rather than just leaving it in, because only missing a few of the best days in the market actually really hampers your returns. So typically speaking, for the long term, you're better off just suffering those minus 40%ers because you've got to remember, you still own the same number of shares as you did before. It's just the valuation of them that has gone down, and things typically recover unless, Armageddon happens, for example. Something else to bear in mind about indices is that they are typically very US weighted. Anything that's got US in the name is obvious, but anything else that is global, such as the world indices, will also have a very high US weighting. And this is because the United States makes up a vast proportion of the global valuation for equity markets that are accessible in the developed West. A follow-on problem with that is that a lot of the outperformance in the United States has been driven by technology stocks. So you find that indices like the S&P 500 have a very high weighting to tech, and right now technology stands at 32% of the entire of the S&P 500. Given that there are multiple sectors in there, having that much exposure to one sector might not be ideal. Even within that as well, it has extremely concentrated holdings. If you look at the top 10 holdings within the S&P, the top 4 makes up 20% of the entire index. Remember, we're talking about 500 companies here. We have 4 companies that make up 20% of the entire index, and the top 10 list is 30% of the entire index. This is quite remarkable, and there is very high concentration risk within the S&P 500 for this particular subset of names. And a lot of them are correlated because many of them are part of this same sector. Now, that being said, I tend not to worry about this too much. Market cap indices typically perform this way, and when you get big drawdowns in the market and one particular stock falls a lot, then yes, you do end up getting a big hit on your index position. However, the thing you have to remember is that then will reduce the weighting going forwards on that particular stock. This is the way that indices have performed through all time. The winners rise and the losers fall, and naturally the winners end up as a bigger proportion of the index than anything else. This is just the way it is. So I'm personally not too worried about it, but past performance is never a predictor of future performance, so we can never know. Maybe at one point this will crack, but so far it doesn't really seem like there's any reason for it to. On this basis then, is it passive? Well, kind of. As a layman investor, you don't really need to pay attention to the actual companies or the economics or really any of it. You just invest consistently throughout the year in a particular index, and jobs are good 'un. You make sure that your time horizons are set, that you're not going to need the money, you don't need it for day-to-day expenses, and you probably won't need it in the next 5 years, and you should be good to invest on the basis of a 10 to 20 year time horizon into stocks. It's usually one of the best places to get performance on that kind of time horizon without having to actually do anything. And this, for me, is really the crux about getting rich with indices. Is the whole point that most people know that they should be saving, but many don't. Those that do save then don't actually know what to do with their money. And this is actually a lot better in the US than it is in the UK. We have a lot more people investing in the States than we do in the United Kingdom, and that's just due to culture. And unfortunately, it really stops people from bridging the gap between making some money at work, having some extra cash, and then making that leap to then invest your money so that the money is working for you without you actually having to work for it specifically, which means that it can be earning money for you and for whatever goals you have, your retirement or whatever it is, alongside the work that you do in the day. And that force is very powerful and multiplies through the years to propel you and actually make you rich, admittedly in the long term. But all of this investing stuff is a marathon, not a sprint. All right, so making your money make more money is obviously a good thing. So how do we actually invest in an index? An index itself is just a number. What it is fundamentally is a list of a number of shares and their prices all multiplied together and gets you a figure. But that's not something that's investable. So we have to decide on a product that we can invest in that's linked to an index in order to benefit from the performance. For most people, this is typically either an index fund or an ETF. An index fund is managed by a particular company and you have a minimum investment requirement. And when you buy portion of the index fund from that company, they go out and they buy the underlying shares for you, and then they give you the returns of the index. That's broadly how it works. It's an older style, it's typically less flexible. I personally have never actually invested in an index fund because I much prefer the flexibility and the more modern nature of ETFs. An ETF stands for an exchange traded fund. So really, it's just a fund that's traded on the exchange like a stock. A stock is traded on the exchange, and so are ETFs. They trade like a stock, so they trade intraday. And rather than you going to an actual company to say, I would like to buy X portion of this fund, you can buy the ETF from another investor. This is what makes ETFs different to index funds, is that you're typically trading in the secondary market, which is the market between market participants on the stock exchange directly, rather than creating new fund units, which can be done, but that's an institutional thing and not for individual investors. This does raise one potentially important question, which is, could an ETF then not be priced appropriately to represent what it's actually supposed to be representing because it's in the secondary market? And the thing there is that there are enough people arbitraging the two, buying baskets of shares and selling ETFs and then converting them across to actually keep those prices in line. So there are market makers out there to make sure that the prices are in line, because if they're not, then those guys can make some free money. So when you're buying and selling ETFs, as an individual investor at least, you shouldn't worry too much unless you're doing something super strange. You shouldn't worry too much about the big generally listed indices like the S&P 500, any ETF that is tracking that. They should be fine, and any premium or discount really should not be noticeable from an individual investor's perspective. In the United States, investors do benefit from a broad range of very cheap funds. One of the reasons for this is that normally you're buying American stocks in US dollars. This allows you to buy VU, which is the Vanguard S&P ETF. This has been around for a long time and only charges 3 basis points, which is 0.03% per year in management fee. This is very small. There are newer funds like SPGL, which only charge 2 basis points, but for the US investor, over many years, you're still hardly going to notice the difference between these two. In the UK, it's slightly more complicated because if you're buying assets in US dollars, well, we're starting off with UK pounds. So you probably don't want to be buying US ETFs. You want to be buying a European equivalent. And one of the reasons for this is that I would encourage all UK investors to use one of the tax-free wrappers like an ISA in order to shield your investments from capital gains and dividend taxation by the UK government. This is a very useful thing to do. But unfortunately, it means that you normally have to invest in assets that are listed in pounds. You don't have to do this. You can buy, it depends on the broker, you can buy dollar listed instruments, but normally there's no control over the foreign exchange rate. And this is normally the killer for the ISA platform, because ISAs can hold dollar stocks, but they can't hold dollars directly. You can't deposit pounds and convert it to dollars and then buy it there. You just have to take their FX rate on the spot when you purchase it. And those spreads can be quite wide, up to about 3%, which is absolutely brutal. So typically UK investors would do better to buy an ETF that is already listed in pounds. And my favorite one for this is VUAG, which is another Vanguard one, but this is in GBP, and this is on the S&P 500 as well. There's another one from Vanguard. There's two. There's VUAG and then there's VUSA as well. And the difference between these two, VUAG is what is known as an accumulation ETF. And so whenever there's a dividend paid out on the underlying stocks within the S&P 500, the ETF reinvests that dividend back into the index. This means that you don't end up with cash lying around and it invests itself back for you. VUSA is different, and anytime that there is a cash dividend, it's stored up in a little pool, and then the aggregate dividend is paid out once a quarter to end investors. So you will just end up with cash delivered into your account. It's typically just easier to get one that reinvests back into the ETF because you don't have to worry about handling the cash or anything. But obviously some people like to have that cash flow directly, depending on what your investment goals are. Over the past couple of years, I actually ended up moving out of the US-centric S&P 500 ETFs and more into something a little bit more broad focused. Whether that's been good or not, it really is up to you, but I usually am investing in MSCI World now. It is a bit more expensive, 20 basis points, but SWDA is the one that I'm using because these normally only have about 70% US and the rest is international equities. And I quite like having an even more broad base than the S&P 500 because of some of the things we talked about before. I'm still mostly weighted there, but because of diversification and some of the concentration that we get in the US, I'd rather have a little bit of a broader exposure across the world. But that's just a personal decision and it really is up to you. As someone who worked in the finance industry for quite a while, I have most of my investments in passive ETFs because I just don't think that I have an edge on the market versus other people who are participating on the single stock level or anything else. And also, I'm busy doing other stuff. I don't want to be looking through all of these portfolios day to day unless I have some very specific idea. But even still, typically I found my performance is better when I've just taken hands off the wheel and just invested in indices rather than trying to do anything myself. So with that, happy investing, and I'll see you next time.